Today is Sunday, the 21st of July. This is a recap for the stock market activities for the week that was and an outlook for the week to come. And folks, I got a good one for you tonight. Apologies in advance. Your boy got caught with this whole Delta Airlines outage and delays. We got home late. Otherwise, I would have split the videos for you and gave you more content and earlier content, but here we go again with the outage problem, which we're going to talk about in a minute here. But before we begin, oh boy, this week was one of the most interesting weeks we've seen so far this year. Not only because of the market action, but also because of the twists and turns we've been seeing so far this election season. Let's begin by saying it's been a week since the assassination attempt on former President Trump, and we're now learning how close it was to changing history. You can see the shot right here, aiming right to the head. And then the guy turns around so he can look at some chart, and he takes the ear instead. So what is the lesson here? Number one, looking at charts can save your life. So don't skip the charts analysis that we do in this channel every day. Otherwise, you might lose your head in this market action. Number two, perhaps the orange man is luckier than this orange lobster who got saved by a red lobster dishwasher, recognizing that the orange lobster is 1 in 30 million and decided to spare his life. And of course, the red lobsters were upset, complaining to the chain about bias and orange privilege. But look at how cute this guy is. Look at the eyes. Look at these eyes, these baby eyes. How could you eat that guy? When you think about it, all animals are cute. They got pretty eyes. I mean, you look at the eyes of a cow or a chicken before. You look into the soul of that animal and you immediately become a vegan. Of course, this is not why Vice President nominee for the Republican Party, J.D. Vance, became a vegan. He became a vegan by marriage. You see, his wife came to the stage and said, my husband decided to become a vegan once he married an Indian woman. She was waiting for the audience to clap and nobody did. This is the Republican Party, darling. We're like hunting and shooting animals. I don't think I can go full vegan though. I'll stick to eating eggs so long as they come from the chicken from my yard, the goat milk and cheese that comes from my goats. I can look at them in the eye and still feel good. So I think that's going to make me a vegetarian, right? Anyways, immediately after the assassination attempt, of course, the odds of Donald Trump becoming the next president increased dramatically. And with that, of course, came the pricing in the stock market. And we've seen what it's called as the Trump trade, at least according to the media. And some of those moves, of course, came from Bitcoin. They say that he's going to be friendly to Bitcoin, so that went higher. He's not going to be friendly to China, so Chinese stocks went down. And of course, the stock of DJT went higher. So there is an impact by market expectations about the elections. The problem is there is no guarantee in knowing what the policies of Donald Trump would be if he indeed becomes president, because between now and then we have a lot of time. And it appears that Mr. Trump is already changing his policy tone. Maybe the shot missed his head, but got his brain regardless. The man came out this week saying that he's going to keep Jerome Powell as the chairman of the Fed. But the only difference between you and Biden was you were the guy who's going to give Jerome Powell his pink slips. Now we want to keep him as the Fed chair? Okay, what is the difference here? Not only that, Mr. Trump now wants to nominate Jamie Dimon as the next Treasury Secretary, which is, again, another disaster. Nobody rational would even say anything remotely close to that. What's next? Donald Trump is going to become an advocate for Ukraine and the money laundering operation? Oh yeah. We got the news that Trump had, according to Zelensky, a very good call. I asked them for money. So who knows? Maybe his policies are going to change by the time he becomes president. And of course, Mr. Trump came out this week promising massive tax cuts, which of course the stock market loves. The only problem is, can somebody pretty please ask him, how are you going to do massive tax cuts when you have an insane budget deficit and an insane national debt? Or you're going to cut spending? Good luck with that. It doesn't pass the smell test. It doesn't pass the math test. You can give the massive rate cuts, but that's going to be at the expense of increasing the national debt dramatically, which, by the way, means inflation. More and more inflation. And the stock market at some point will have to price that in. So that's the mess on the Republican side. What about the mess on the Democrat side? Because today, we finally got the confirmation. We've been talking about it for weeks now. Your boy Joey B got his pink slips. He finally admitted that there is no way he's going to be president again, and he dropped out of the race. Goodbye. And of course, this presidency has been a disaster. You look at the economy, insane inflation, now turning into stagflation, housing inaffordability, gaslighting about economic data, not really addressing the true issues that's going on in the economy. And now the party appears to be even losing unions and the labor side. You saw what happened over the RNC convention. You got labor unions speaking in front of the Republican Party and getting applause. And the question now becomes, what does the Democratic Party really stand for if you're losing the unions and labor? Oh, Wall Street, the oligarchy, the billionaires? Bunch of Hollywood moguls? Then you look at the geopolitical front. It's an absolute mess. Not only we have this dangerous situation in Russia-Ukraine, it appears that the Middle East war is now escalating and broadening out. This week alone, we've seen the Yemen Houthis striking Israel in the heart of Tel Aviv. Massive explosion. Israel, of course, responded by bombing some oil refineries in Yemen. And this tit-for-tat will escalate. And we will see more attacks, more aggression in the Red Sea, which is, of course, inflationary, as we see shipping rates going higher, insurance rates going higher, goods taking longer time to arrive at ports. And now we hear talk about the Russians perhaps providing the Houthis in Yemen with advanced anti-ship missiles. And you got China not liking what's going on in the Middle East. They see lack of stability, lack of leadership by the United States. There's a vacuum, so they're stepping in to fill that vacuum. Needless to say, it is chaos. And with chaos, of course, comes economic instability, as nobody can predict where inflation is going to go if we see a flare-up in geopolitics. But now, Joe B is gone, and the talk right now is Kamala Harris, the VP, will be the replacement. Of course, she has no chance, snowball's chance in hell, in winning the presidency. So for now, the market will be in the same mode of, oh, Trump is going to be president. We have to price in a Trump presidency. The problem with that is, will his views change? Did they get to him? Hey, the next one, we're not going to miss, so you better get into the program. We'll make you president, sure. So the question now, how can we price his policies anyways, not knowing where he stands when he's changing your views one day to the next? Here's the problem, though. I think the market will be surprised that Kamala is not going to be yet, because choosing Kamala as the presidential candidate by the Democrats is equivalent of surrender, of them saying, okay, we're not going to have any chance here of winning, so we're just going to push Kamala in and see what happens later. The question now becomes who's going to be the actual replacement, because if you notice, this is the headline from today, that Obama did not endorse Kamala Harris, praised Biden, but did not make an endorsement. We have Joe Manchin now saying he's going to register as a Democrat officially. He's going to flip back and run for president. Now you got Kamala, Manchin, two different policy outlooks, two different policy pricing by the market. And folks, look, we talked about this last year, not 2 weeks ago, not 2 months ago, not 6 months ago, but a year ago. We talked about how once we get closer to the elections, Joey B is getting the boot, and now we see this prediction coming to pass. But the part of the prediction that I'm not sure about is I said the replacement will be Hillary. The problem here is if you take Kamala out, and she's already VP, she's supposed to take it. If you take her out, you're not going to replace her by Gavin Newsom, a white man, when you take a woman of color out. And you're certainly not going to replace her with Hillary Clinton, a white woman. That would be for sure a recipe to alienate the constituencies, and it will be hard to sell. So who's going to be the replacement really if it's not Kamala? And when you brainstorm all the possibilities, you come out with one candidate alone, and that is Michelle Obama. In the polls, the only Democratic nominee who could beat Donald Trump by a wide margin is Michelle Obama, not Kamala, not Gavin, not anybody. Because, of course, a lot of people look at it as the extension of the Obama presidency, the third time of Barack Obama being president. And now the market has to do different pricing, moving away from pricing in Donald Trump as the next president to Michelle/Barack Obama becoming the next president. And that's a different dynamic in the market altogether. In other words, a recipe for more volatility. And guess who've been talking about this before it even happened? July 2nd, we said this is the last week of calmness, the bottom in volatility. And we said the Biden's going out, Kamala will take over, but Kamala is going to cause a lot of volatility because it's not a serious candidate. And now the speculation would be, who is it going to be? And with that comes a lot of volatility, and we have seen the bottom of volatility for the year. Take a look. The volatility index. The hourly chart, what do we see here? At the lows, folks. New lows, gap and crap, day after day. Is it too low, though? We've seen in the last 3 minutes or so of the day, the VIX catching a bit. Is it a telltale for something that's about to come? I think the VIX is way too low. The way I'm going to look at it right now, good opportunity for me to hedge my portfolio. Good opportunity, as I said in the stream today, for me to look at my portfolio and hedge pretty much every single name using ETFs, puts on ETFs, or in the individual names, depending on the sector exposure that you got. Taking advantage of suppressed VIX, meaning really cheap put options, and weather my portfolio for a 5% correction. And I can go all the way till September. It ain't going to cost me a lot. Then if we see the VIX moving higher above 1324, we can talk about, okay, now you don't only want to take advantage of the VIX in terms of hedging, but also betting to the downside. an ABC breakout. Another way we can look at it, if we clean up the chart, we use a line chart instead, perhaps bottoming or what we call it inverse head and shoulder pattern. The VIX hourly chart maintaining the pattern of higher lows. Now, if we close above 12.75, confirmation that we're going to rally back to 13.24. Closing above that number means that 15 is coming really soon. The VIX daily chart, do we have a tension pattern here that will break to the upside? And if we do, we got target number 1, 1388. And after that comes 1487. Let's call it 15. If we do that, we have a major breakout coming. That could take us all the way to the 20s, but one step at a time. And indeed, the VIX with a big pop, and I think that we have more to come. Once again, we'll cover the chart of the VIX in the charts analysis in a minute, but we also talked about the rotation before it happened. We talked about how we could see a dash for trash rotation into the IWM. We will witness an explosive move to come. Take a look. This is a bear flag pattern, at least for now, and if it is, we're probably going to close the gap at 201. But this is a pivotal week for the IWM, and it's going to depend, the fate of the IWM depends on the CPI. Of course, the viewer says, should we do a reoccurring Monday IWM poop trade? You can do the pop, you buy it Friday, then you do the poop as we open on Monday. That could work out, at least it's been working out in the last 2 weeks. But the problem is you might be running out of time because you look at the daily chart. We've been in this tension pattern right now. Look at how tight the Bollinger Bands have gotten. This is the tightest they've been. I can go all the way back a year, more than a year. You never find them this tight, meaning that we have a bigger explosive move coming. Of course, there is the school of thought that says tame CPI means yields go down and we see the dash for trash led by the IWM and we see a big pop higher. Another school of thought says no, yields are going up because hotter CPI and we see a big flush down in the IWM. I would say a big move is coming. In a straddle situation here would make sense. Straddle meaning buying a put and a call at the same price with the same expiration date, betting on an explosive move one way or the other. I wouldn't do the weekly though. I would do the monthly expiration. It will cost you, but it could be paying out big. And the IWM since then exploded higher. This week, it got too exhausted. It went way too high, too far in a short amount of time. Of course, we have a lot of false assumptions behind the rally in the IWM. We talked about this in previous video. We'll talk about it again. But we also talked about the top, at least in the short run in the IWM. It gave us a nice, clean topping signal this week. We took a shot on it using TSLA calls. TSLA is the inverse ETF for the IWM, and indeed, after that, the IWM went down, TSLA rocketed higher, and we scored gains north of 260%. We talked about the correction in the Qs before it happens. Take a look. Look at the daily chart once again, trend line since the last correction. If we have a real serious correction this time around, I think we go down to the trend line that'll be in or around, let's say 475, depending on where and when we hit the trend line. And now the NASDAQ is back to target. Breached the trend line, so now the debate becomes, do we rebound this week, find support, or do we go down further? Once again, we'll do the charts analysis in a minute. But folks, all of what happened, we've been talking about it. For example, July 10th, we said we only see this before corrections and crashes. About the weekly RSI for the S&P 500. We talked about rotating out of the market altogether. Next rotation will be out of the market. You saw what happened Thursday and Friday. The initial rotation was into small caps, the IWM, and the risk-on segments from the AI mania. And the catalyst for that was a tamed rating of the CPI. But as the week progressed, we've seen a rotation to the value/risk-off part of the rotation, the dividend-paying names. That was around Wednesday. And then comes Thursday, Friday. We got a rotation out of the market together, which we call a rotation to the dumpster. The frustrating point with the audience is when we put these kind of things, you bitch and moan and cry because your scope of vision is only the next hour and the next day. If we say something and it doesn't happen tomorrow, you bitch, moan, and cry because you're a bunch of babies. But there are certain market dynamics that you have to be aware of to see what the next move, not the next day or the next hour, what's going to happen next week, the next month, the next year. What is this rotation all about? In the past, when we've seen rotations like this, where did it lead to at the end of the day? Of course, there's a trade that we can do in the meantime, and we talk about that all the time. But what is it going to lead to in the long run? Of course, as the title implies, we're going to discuss the rotation right after the implosion of the dot-com bubble. What happened after that? So let's talk about it and segue from the politics, geopolitics, and all of the mess to the mess that we have in the rotation. Because the question is the sustainability. We've seen these rotations before. Oh, they dash for trash, the light at the end of the tunnel, and they fail. Will this one fail too? Well, Barclays says don't bet on the stock market rotation, as small caps historically suffer when rates come down. This is a really important thing for you to understand. Because when we talk about the Fed cutting rates, everybody assumes that that's going to be good for the economy, that this is going to ignite a rally in the laggards. In this case, the IWM, the small cap stocks that suffered from interest rate hikes. That when the Fed talks about cutting rates, all of the risk that we have in the banking sector and the commercial real estate sector is alleviated. And this is why in the short run, small caps, the banks, regional banks specifically, and commercial real estate were the biggest winners, because we're in the honeymoon period now of the rotation talk. But as more data shows up, the rotation will show you its ugly side. So don't bet at all on one side of the rotation. Otherwise, you might end up like Kevin Costner. The guy spent millions of dollars on lawyers to avoid splitting his money with his ex-wife. And he bet it all instead on this movie Horizon. And now he's bankrupt.
Pour me one, would you?
At least he lost his money on his own. Give the guy some credit. But I want you to look at this headline too. It reads, SunPower stock plummets 73% in a week to trade below $1 as the residential solar company pauses operations. And we've seen a lot of stocks that once earnings come out, all of this rotation to these kind of stocks, case in point, JB Hunt. Oh, the Fed is going to cut rates. That's going to revive the beaten down trucking companies. But then comes earnings, and earnings say, not too fast. We got a problem here. We got a recession in this economy, and that's why we're cutting rates. But just because we're going to have a recession, that doesn't mean that the inflation problem is over. And this is the problem that we have right here. It's stagflation. It's duality of the risk. If you cut rates to alleviate the recession risk, you're bringing back the inflation risk. If you don't do anything because you're afraid about the inflation risk, you're only allowing the recession risk to grow. It is the worst period of investing. It's the worst period in an economy, and you're about to see that. See, we talked about this rotation. We added to the conversation this week from last weekend's video. But we said that we got an initial rotation from the AI mania to the risk on. Risk on means what? It means beaten down IWM, small caps, everything that had risk with higher rates, the regional banks, the profitless biotech companies, the startups, the solar companies, the commercial real estate companies. All of these names were the benefactor initially because we've gotten a rotation from AI mania to risk on. But as we kept getting more and more economic data and the rotation into risk on got ridiculous, comes Wednesday of this week, we've seen a rotation to risk off. Look at the action that we got on Wednesday. It was a maverick kind of day because the value stocks outperformed by a lot. The dividend-paying stocks outperformed by a lot. But the IWM topped during that day. We've seen an epic reversal intraday. Then we talked about the rotation into the dumpster, which is everything sells off. And that happened Thursday, Friday, everything went down. Doesn't matter. Dividend-paying, value, no value, doesn't matter. Everything went down. And the catalyst behind that is the rebound in the dollar and bond yields. You bring those up. Now you can't keep the risk-on rotation. You have to question the risk-off rotation too. And certainly, can you rotate to the AI mania? Maybe you can with the dollar and bond yields going higher or rebounding. But you can't do that when you have lousy earnings by companies in the AI mania, such as ASML and Taiwan. On paper, the report is good. But then you look at the quarterly trends, and it is alarming that maybe we have a peak in the AI mania, and we've priced everything. Every good news is already priced in the stock performance. We see them going down. The question now becomes, are we going to stay in the rotation to the dumpster? Or are we going to rotate back to AI mania or risk off, risk on? The problem with risk on, which is IWM, real estate, commercial real estate, regional banks, the profitless stocks, you know the deal. The problem with that is once the realization is cemented in the market that yes, the rate cuts are coming, but for the wrong reasons, as Barclays says, the rotation goes kaput, gone. You look at this headline here from the Wall Street Journal. They say that the Fed should cut rates now, not wait until September. Do it now. And I told you on Twitter, they're begging for rate cuts right now. The question is, why are they begging for rate cuts right now if we have the bestest economy ever, right? The inflation rate is coming down, the unemployment rate is going higher, but it is exactly where the Fed wanted it to be. Wages are good, and the banksters keep saying that the economy is robust and the consumer has plenty of cash. Why are we cutting rates? Maybe we are at the R-star rate, which the Fed has been looking for decades now. Why do you want to cut rates at this point? Well, we know why. You're cutting rates because you see the tsunami of the recession coming. That's why. And you think that rate cuts will somehow prevent that from happening. You're also forgetting that cutting rates could bring the other risk. So when we assess the rotation, ladies and gentlemen, we have to understand a few things. The dynamics of the dollar and bond yields. When you have the dollar going up and bond yields going up, what does that mean? It means that the market is now expecting a tighter policy by the Fed than, let's say, previous days, previous weeks. And when that happens, is that good for the stock market? No. So we see a rotation to the dumpster or rotation to the AI/mega cap mania. And that was the case in 23, early 24, because sure, the dollar goes up by a little bit, yields go up by a little bit. So long as they're not making new highs, they're just yo-yoing back and forth in a range, which we call the pause in monetary policy. They're not raising rates, they're not cutting rates. The market looks around and says, okay, where do I allocate the money at this point? The only companies that could withstand higher rates and higher dollar are the bigger ones, the mega cap mania and the AI mania, companies that have a massive tailwind from this spending and overpricing of AI chips. That was the case. The problem now, when you have dollar going up, yields going up, and there's a negative catalyst for the AI mania coming from chip earnings, then you go to the dumpster with this kind of dynamic. Now, if we have the dollar going up and yields going down, what are the implications? Dollar going up, that implicates that we have investors rushing to the safety of the dollar. But yields going down, it means that we have investors also rushing to the safety of bonds. And that usually happens during corrections, crashes, risk-off periods of the market. So we see the risk-off rotation, not all the time, because if we have a massive panic toward the dollar and bonds, okay, that's a crash, everything goes down. But if it's just a little bit in the meantime, because of sentiment or because of a macro data, you see the risk-off rotation taking over. Dividend paying value names, that kind of stuff. If you see the dollar going down but bond yields going higher, what are the implications here? The dollar going down could be because of the strength of a foreign currency, it could be because many other reasons. But yields going higher implicate that perhaps we will see a tighter policy by the Fed. In other words, indicates an inflation problem. Now, this circumstance is really rare because we seldom see the Dixie, the dollar index, and let's say the 10-year yield, as you can see in blue here. We seldom see these two trading against each other. They usually trade with one another. But from time to time, we see the divergence. Case in point, of course, if we go back to 2020, when bond yields in blue were going higher, but in orange, we see the dollar trending down. That was good for crude oil. Crude oil began to move higher because the market message here is, watch out, we have inflation about to come and about to show up. Now, when we look at the dynamic of the dollar going down, and bond yields going down, what does that mean? It means that the Fed is going to ease the policy. And there is no panic because we're not buying bonds either. The rate is going down. So we see risk on, it favors the IWM, the profitless companies, the dash for trash kind of rotation. So here's what we need to know for this week. When we talk about, are we going to rotate back to AI, risk off, risk on, stay in the dumpster, what are we going to do? The case for the rotation back to the AI/mega cap mania is we see no change in macro, no more, let's say, severe recession news or reinflation news. We stay as it is, but we see a save from earnings. We see one of these companies, and we have, you got Google, that's the big one for this week. And that's the only one that could do it, to be honest with you. If that company delivers, I think we could see a rotation back into the AI mania because, number one, a lot of them will be oversold. A lot of investors would say, okay, now we've got an excuse to buy the dip in the AI mania because where are we going to go? The risk on, risk off rotations, not really solid. The dumpster rotation, we're not there yet when it comes to the economy. So we see a rotation back into the AI mania. Are we going to see a rotation to risk off again? Value, dividend-paying names. Well, we need to see weak macro data, not horrific macro data, just weak, showing weakness that we're heading into a recession, plus sticky inflation. And with that comes a drop in yields. But the market will read it as, I'm going to go with the drop in yields as a catalyst for the risk-off rotation, not the risk-on. Why? Because we have weak macro data. And that could come from the PMIs. Say the PMI, manufacturing services, they show that pace of economic activity is slowing down dramatically, but the price index is sticking, if not moving higher. That could be the case for the risk-off rotation again. What about risk-on? The most serious catalyst that we have this week is Friday's PCE report. Of course, if the PMIs show a soft landing scenario, such as we're seeing the pace of economic activity moving higher, but pricing going down, then that's going to be good for the risk-on. But I think the one that could do it would be the PCE report. If it shows that inflation went down dramatically in the report, whether that's true or not, doesn't matter, that's what the Fed looks at, then we'll go back into, okay, maybe we should stick with the risk-on rotation in the small caps because the Fed indeed will cut rates. And oh, by the way, We have a dip in the IWM, so you're not going to hold your nose while you do that rotation. Now, what about the rotation to the dumpster? If we get recessionary or reinflation data from the PMIs, from the PCE, doesn't matter. We see flows into the dollar and bonds. So bond yields go down, but the dollar goes up. And I think we'll stay in the dumpster. We're going to sell everything. So this is how I see the rotation happening. And of course, I want to add to the conversation from last weekend. A lot of folks looked at this when I explained the rotation and said, hey, Maverick, you forgot about energy. Do you like energy as a rotation or not? You can see this week we got a divergence. The commodity went down, but energy stocks went higher. My 2 cents is the following. Energy is in a weird spot right now. The rotation into the IWM and the promise of rate cuts causes a lot of confusion in energy, so you can't really lump it in one category versus the other, risk on, risk off easily. It can fluctuate from risk on to risk off. On one hand, these energy stocks are still value and they pay a lot of dividend, so we can say these are actually risk off. We can say that they're risk on because if we have a soft landing expectations and expansion in the economy again, and that's why we're pumping these small cap stocks, then doesn't it make sense that we will see more demand in oil and higher prices to come? So oil is in a weird spot. You can't really pinpoint it, but we know for sure that oil/energy, at least in the commodity level, thrives once the rate cuts actually happen. So for now, my positioning is I'm still long energy stocks, but I hedge. Every time we have piece of recession news, I hedge because they have an impact. And I'm going to stick with this strategy until, of course, the macro changes aggressively one way versus the other. And if we see a rate cut coming prematurely, of course, I'm going to go all in energy because we will see an explosion in oil pricing at that time. Now, let's segue back to the dot-com days because a lot of folks say, have we seen this kind of rotation before? Yes, we've seen them. And usually they don't end pretty good. So what you're looking at right now is the NDX, the chart of the NASDAQ 100. And in orange, you're looking at the Dow Jones. Back during the dot-com mania, we know that the juiciest period of the dot-com mania was the fourth quarter of 1999 into the first quarter of 2000. The NASDAQ almost doubled in value. The Dow Jones was the laggard. It was actually negative until the first quarter of 2000, when it went positive by about 5%. But the point is clear here, that the Dow Jones underperformed. Then in March 2000, we've seen something weird happening. We've seen outflows out of the NASDAQ, the dot-com names, into the Dow Jones, the value kind of names. And the NASDAQ was down about 22% during that period, while the Dow Jones was up about 7%. But then you fast forward and you look at the performance from the top, the peak of the dot-com bubble, all the way to the bottom. The NASDAQ went down by almost 80%. The Dow Jones went down by about 23%. So it was an outperformer. But needless to say, it went down. Why? It's the weight of these technology stocks coming down. They become too big of a snowball to ignore. Even if you're just looking at the Dow Jones or the S&P or the IWM, they have an economic impact when they go down. And sooner than later, any rotation you want to play, you're going to get called out. And you realize that the real rotation should be all the way to the dumpster for everything to correct. And then we have a new phase that begins. And that's exactly what happened in the dot-com bubble. But needless to say, the rotation was a warning sign that we're getting really, really close to the end. If not, we've already hit the end in the mania. So the question now becomes, did we hit the end of the AI mania? This is not the only correlation that we got. I think this story of the axing of analyst Marko Kolonovich by JP Morgan is an important one. And I call it a story because the event that will happen after will change the course of history. Everything that happened after that event, and horrific things will happen, will be traced back to this event. I think people years from now want to hear the story. What happened? What led us to that event? That's when the channel you're watching right now will be appreciated. But part of the story will be the axing of Kolonovich because it marked the end of the last bear on Wall Street. And it echoes, of course, what happened in 1999 when the last bears were axed out of the market and out of Wall Street. The headline from November 9, 2000. Few months into the crash of the dot-com bubble, the $1.7 trillion dot-com lesson. It was a loss of $1.7 trillion from the peak of the dot-com bubble all the way to November 9th, which was not the bottom, by the way. Now imagine this, we have lost $1 trillion in market cap this week alone from the mega cap rotation. If this is indeed the top and we trend down from here, we're going to lose trillions to come. You think that's not going to have an economic impact? Think again. But again, we go back to the parallels. The rotation in 2000 from the dot-com names to the Dow Jones kind of names, the axing of the last bears, and of course what we've been talking about for many videos now, the absolutely horrific breadth in the market. And when you fix it, it's too late. This is the headline, December 31st, 2000, New York Times. Internet stars obscured the overall picture. In a year of records, most U.S. stocks fell. Sounds familiar? Listen to this. It is easy to overlook amid the current Wall Street frenzy, but most U.S. stocks fell in 1999. The major market indices are closing out the year at record levels. But most of the big winners have been related to the internet, because it is the future, right? Like AI? Anyways, for 1999, the dichotomy between winners and losers was the most evident on the Nasdaq stock market. The system's composite index, which measures all of its stocks, has risen 84%, the biggest calendar year gain for major U.S. average, bearing a huge sell-off Friday. That's Black Friday, by the way. If you remember, you can never forget about that day. But dig a little deeper and you find out that most Nasdaq stocks were down this year. Sounds familiar? Anyhow, what is unusual, however, is that even with the Dow Jones Industrial Average and the Standard & Poor's 500 showing double-digit gains, most stocks were down, with less than a week left to go in the year. Falling issues outnumbered advancers 3,780 to 3,213. With the New York and Nasdaq markets combined, we've been having this bad breadth issue in 23 and 24 throughout this AI mania rally. Now folks say, but we're fixing it. The breadth is now improving. The IWM is performing. The Dow Jones is leading higher. The value names are coming back. So they did in the beginning of the year 2000 at the expense of the dot-com stocks, but it did not last. And all of them went down together. Any other parallel we have? How about the Y2K phenomenon? Everybody was talking about it. It's going to be bad. The market is going to crash. It was ignored, of course, shaken off before Taylor Swift was a thing. And the market rallied anyways. And guess what? Nothing happened in Y2K. But 3 months later, it did. It was a wake-up call to the limitation of technology. What did we have this weekend? I call it our Y2K moment, a devastating outage that showed the limitation of all of this crap, the consolidation in few tech companies, the limitation of AI, because imagine if we gave everything to AI and then we have an outage, or we have a malfunction, or we need an update, or AI decides to rebel. It's a window to the future. What happened this week? Airlines were grounded, banks were down, medical services down, emergency services down, and that was because of the outage coming from CrowdStrike and Microsoft. Now, your boy experienced this firsthand. I told you guys Friday I'll be traveling, and I was using Delta. First thing I woke up to in the morning, hey, your flight is delayed. I go to the airport, it's an absolute chaos. It's a mess. The lines are huge, as far as the eye can see. Everybody got their flights canceled or delayed. I go to the bank to make a deposit. They say, I'm sorry, sir, but our systems are down. You can't make a deposit right now. Okay. Go to the doctor's office. They say, look, our systems are down. We can't have your consents and background information. So we have to fill them again using paper and a pen. Otherwise, we cannot proceed with anything you need. Not to mention, of course, the surgeries that got delayed. God forbid if you wanted to call 911 and they couldn't help you out because we have an outage. How the hell did this outage happen? It is because of a software update by the company CrowdStrike. Everything went down because of that. But when I say everything, by the way, I mean only less than 1% of Windows computers. And that was enough to send the world into chaos. Imagine if we lose 5% of computers. And of course, sticking it to Putin and all of that. Listen to this. Russia thanks Western sanctions for helping it avoid the CrowdStrike IT outage. Wonderful. But here's the point, folks. We're going to look at things differently now. I know the propaganda in the media, specifically the financial news media, they say this is idiosyncratic, will be dismissed, it's just a one-time issue, it was fixed quickly, and everything will be hunky-dory from this point on. That's their job. Their job is to spew propaganda every single day. But the truth is, while certain companies handled the outage pretty good, I would say Delta Airlines did, despite the inconvenience. They did their best, and this is why the stock reversed back higher on Friday. But the point being is, are these companies too big to fail? Are we placing all of our eggs in one basket with the reliance on these handful of technology names? Are we overestimating the capacity of these mega-cap technology names and the promise of AI? The Washington Post says that officials say the incident highlights how much businesses and government rely on the giant's products, talking about Microsoft. There will be a process of rethinking that yes, we have a consolidation problem. Number one, we have an overestimation problem to the capacity and the capability of these technologies and companies. And it might seem like nothing right now. We might see everything going back to normal next day, the day after next, but we forget about it. But this event will change behaviors, will change the perspective about these companies. And if we're talking about a rotation that damaged these companies, now we have another catalyst that will damage them even more. And boy, if earnings, big cap technology earnings, and chip earnings come out, let's say, not so pristine, that could be another whammy. It might be the case that we've already seen the top in this mania, and this was the Y2K moment. We know that when that happened, a few months later, the crash took place, and we never looked back. The similarities are eerie and difficult to ignore, and this is what makes this week really important. It is the week that either we see a save, where these companies come in favor again by investors as the only safe haven, the only companies that are producing earnings and growth reliably, or are we going to see the nail in the coffin that now we got the rotation, and we got a Y2K-like moment, and earnings are showing a peak and overpricing of these stocks, and that will be the end of it. So buckle up, folks. We got an important week to come. But with that, let's segue to the market information, beginning with the closing of the indices last Friday, and here we go. The diamonds were down 377.49 points, or a loss of 0.93%. The Nasdaq also down by 144.28 points, or a loss of 0.81%. And the Spider in the red by 39.59 points, or a loss of 0.71%. The Russell 2000 small caps down by 1.11 points, or a loss of 0.51%. So indeed, Friday was the rotation into the dumpster. We look at the sectors. The only positive sectors are healthcare and utilities, dividend-paying names, defensive types. But then you have technology, energy, financials, cyclicals all down. Of course, led by technology. We look at the performance for the week. We rotated back and forth from theme to theme to theme. And all in all, we got a mix. Real estate, number one, financial number two. So we have real estate. This is the rotation toward risk on from a perspective of these commercial real estate companies will now find the light at the end of the tunnel as we have rate cuts coming by the Fed. On the other hand, real estate companies also happen to be high dividend paying names. So when yields go down, dividend paying names come in favor. Of course, I'm not a fan of this rotation real estate. I'm actually looking at names like Vornado and SL Green, all of these commercial real estate names to move higher so I can short them at a better price. Financials right now in the sweet spot because you have rates, sure, maybe they're going to come down. Question is when, not if. So that's going to alleviate all of their losses held till maturity on fixed income. But at the same time, rates are high enough to keep their interest income higher. Energy, it's the weird story, of course, weird spot. You got the commodity down, but you have energy stocks higher. So go figure when it comes to energy. You got consumer defensive, also in the green. These are the dividend-paying staple names. Healthcare was down, but the majority of healthcare stocks were higher, specifically the dividend-paying name stocks. But of course, with the weight of Eli Lilly coming down because perhaps we're seeing the Ozempic mania also coming to an end as we see the development of pills. Of course, the laggards for the week, technology, comm services, cyclicals, this is no surprise to anybody who's following the rotation. We look at the breadth on Friday, of course, leading to Friday, despite the fact that indices were down. We have seen some of the best breadth in the markets that we've seen in not just this year, but I would say going back all the way to the beginning of 23. I called it the most bullish day of the year last week. This week, we got a day that's even more bullish than last week, but the indices were down. Why? It's the weight problem. Why is healthcare down when the majority of stocks are up? The weight of Eli Lilly. Why are the indices down when the breadth is improving? It's the weight of the mega cap and the AI mania. That's the problem that we've been talking about for a while. And if we look at Friday, the breadth was better, but it was damaged a little bit. When we look at the NYSE, 32% advancing versus 66% declining. The Nasdaq, 33% advancing versus 63% declining. When I talk about the breadth improving, I'm talking about the 52-week highs. As the market was rallying, we were seeing the majority of stocks printing new 52-week lows, specifically in the Nasdaq. When the index was going down, we're seeing the majority of stocks printing new 52-week highs. It's a weird phenomenon, but we've seen it before. And on Friday in the Nasdaq, 40 new 52-week highs versus 74 new 52-week lows. So we lost the rally in breadth. We've seen more new 52-week highs. Looking at the heat map from Friday, we see that again, what's getting hammered? The AI mania, the chips, to a certain degree, the big caps, but mostly Microsoft because of the outage. You see the contrast between CrowdStrike down about a little over 11%, while the competitor, Palo Alto, gaining about 2%. And that's the debate happening right here. Are we relying on a handful of companies? Is it too much over-concentration in the case of cybersecurity on CrowdStrike? And should we diverse away from this company? Now, this could be bad for that company, but good for the companies that we're going to diverse away to, in the case of Palo Alto. And the same, by the way, happens in the big caps. If we're going to go out of the big caps, does that benefit software? You see that image a little bit on Friday. We see ServiceNow, for example, was actually a gainer when the majority of stocks were down. Of course, earnings had an impact on Friday. We have AXP and financials, Amex, that was down. A warning sign about maybe we've overpriced the health of the affluent consumer. We see the insurance companies down big because of travelers. Travelers crashed on Friday. Now, these happen to be one of the top performers in a bubble of their own, by the way, since the year 23 because of inflation. Now, did we see the nail in the coffin, the end of that bubble, by the earnings that we got from Progressive this week and also travelers? I think you can make that case. Healthcare was okay on Friday, few names down. Of course, Eli Lilly caught a rebound on Friday, but was down over 6% on Thursday. I would be really careful with the Ozempic mania. I think it's done, and down we go from here. So if you have the ETF, the XLV healthcare in your portfolio, you need to start thinking about switching the individual names instead. I think the rotation from Eli Lilly to Pfizer makes sense at this point. I think a rotation from overperformers to underperformers makes sense at this point. You will see that in the weekly heat map in a minute, but we also see a little bit of a contrast in industrials and energy. Some names performing, some are not. So in energy, for example, you have SLB in the green. That name reported earnings. You have also KMI, Kinder Morgan. That's also in the green because it had a report, but the giant energy companies like Exxon, Chevron were actually down for the day. And of course, comes the question of Tesla. It's down 4% on Friday. I think this is an options phenomenon more than it is anything related to the company. If we look at the heat map for the week, here it is. You can see it clear. We got a rotation out of the big caps, the Microsofts, the Apples, the Googles, the Metas, the Amazons of the world, all down big for the week. Rotation out of the AI mania in chips, NVIDIA, Taiwan, AMD, ASML, all of them down big for the week. Rotation out of the Ozempic mania, Eli Lilly, NVO down for the week. We got a rotation from the bubbles. I mean, even in industrials, you see it a little bit. The name Eaton is actually down. Eaton is the top performer in industrials year to date, along with GE. But it is down this week, over 5%. What's performing are the laggards, the names that got hammered by interest rates going higher in the risk-on segment of the rotation. The names that got hammered from the increase in interest rates and bond yields in the risk-off segment. In value, dividend-paying names. You see them lining up in the green. Look no further, for example, in the healthcare sector. You have Eli Lilly, NVO down, that's Ozempic mania. But the laggards, the old-school dividend-paying names such as, and laggards, by the way, such as J&J and Pfizer, those were the top performers for the week. We segue to the heat map for the week for the ETFs. The TLT's down, meaning that yields went higher this week. But even with that, the rotation was so strong that you see the IWM small caps printed a green week overall. You see the components of small caps, such as the KRE regional banks, huge win for the week, about 7.5%. You see names like the XHB, ITB within these small caps, XHB Home Builders, ITB Construction, all also gaining this week. I think if we see yields continuing to go higher into next week, the IWM will have to give up ground and go negative. With that, we see a reversal in the KRE, ITB, XHB. Now, what about the real estate IYR? We talked about it before as it could be applicable in both. It could be in the risk-on and risk-off. Risk-on because it has commercial real estate that should get a relief at least from the promise of rate cuts. But then you have the old-school real estate companies that pay high dividend. That makes it in the risk-off kind of rotation. So it's going to be a weird spot, but at the end of the day, if we see yields going higher, bond yields that is, going higher, I think that you'll see both the dividend rotation and the risk-on rotation getting weaker, and that's going to be a weight added on top of the IYR. What's really interesting is the XLU utilities, because we've seen a value type of rotation into dividend-paying names on Wednesday last week, or this week, I should say, depending on where you're listening to this program. But the XLU was down. The problem here is the weight of NEE, Next Era Energy, and the EV plays, not EV plays, but the clean energy plays. Those are going down. So as we said with the XLV, it's supposed to shine under this environment of appreciating dividend-paying names. But the reason why it's not appreciating, when we look at the index level, it's the problem of the weight. Eli Lilly, NVO, and the XLV, the Ozempic mania. And in the XLU, it's Next Era Energy and the clean energy type of stocks. They have a huge weighting in the XLU, and they dragged it down. So we're beginning to see the passive investing bubble, the ETF kind of bubble, beginning to be exposed. That right now we should favor active management, that we should pick individual names and not rely on the lazy, stupid ETF type of investing. Otherwise, you'll get your head chopped off because you'll say, but healthcare should thrive under this environment. Why am I down? You're down because of the weight of Eli Lilly, baby. Talk to your financial manager, your portfolio manager. It's time to get out of the ETFs and pick individual names. What else happened this week? Value. VTV is up, so we see that there is appreciation of value. Although you look at the mega cap growth, IWF, VUG, those are the ones we're rotating out of. So they're down for the week. We talked about that in details. But what else is going on here as a theme? Crypto's up. IBT, FBTC, GPTC, everything crypto went higher in a big way. But then we look at the Chinese stocks, FXI, MCHI, the emerging market ETF, EEM, all of them down. Matter of fact, all international markets are down. And that's the Trump trade right here. The market says Trump, not good to China, not good to international stocks, but good to cryptos, at least for now. So these are the themes that we can extract from this heat map. But with that, let's segue to the commodities. On Friday, all of them were down, at least in energy, down big. We're talking about over 3% for the WTI, Brent. And of course, a lot of folks are asking why when you have a flare-up in the geopolitics. Could it be because of options expiration? That could be. And if that is the case, you'll see a rebound Monday. Could it be that commodities investors are throwing cold water on the rotation to the IWM and the risk-on rotation by saying, watch out, we're seeing a recession. You guys are not seeing it, but we're seeing a recession. So we're going to dump the WTI, Brent, the gasoline, RBOB. Again, this week will give us the answer. If we go back to energy commodities again, then okay, it was an options expiration thing. If we stick to declines in energy commodities, then there is a recessionary message. But of course, you can't say recessionary message when you have lumber and softs going higher and becoming one of the top performers for the week. So again, it is weird. But you can't say that lumber is saying good things about the economy when you have copper down. Again, could it be just options expiration on Friday? We're seeing all of this happening. It could be, because you got grains up. So it was rallying because of the rotation. We see them coming down as folks close their positions. What's been lagging goes up as we see the inverse plays coming in. Could be just an options expiration phenomenon. All in all, for the week, we see oats, soybean meal, soybeans, lean hogs, lumber, all of them the outperformers for the week. But we see nat gas, copper, cocoa, palladium, coffee, OJ, all of them down by more than 3% for the week. On to the options market, the big casino. What do we see here? The volume was surprisingly low under an options expiration day. And it tells me that traders, at least in the retail side, are programmed to trade one way, which is, oh, stocks going up, let's just buy calls. And when you see the indices not performing, they shy away from the market. So we see the volume down. But by this behavior, by the retail investors and traders, you've allowed the market maker to drop the tape down on Friday, because Friday was an excellent day for a rebound. Had the retail traders participated and bought calls, they could have influenced the market maker easily to create a rebound, but they did not. So the market maker went with the feedback they have, which is more puts being bought because the calls were already dead. So closing calls was not the issue here. The issue was they're closing puts, but they're rolling down to these puts. So they close a profitable put and then the roll down to a lower strike in these puts. So the market maker looked at that and said, okay, I guess they want to push the market down. So I'm going to sell right now. That way I'm not caught with my pants down if indeed the tape goes down next week. Otherwise, the traders could have flipped that on Friday easily had they participated and bought calls. Anyhow, when we look at the IV rank, it's really important to distinguish here that when you see higher IV ranks and the stock was moving one way into the increase of the IV rank, when you get excessive to the 90s, 100s, you're probably going to see the opposite move. This was the case in Meta, for example. Meta was increasing the IV rank as it goes down. So once we got closer to 100, we've seen a rebound in Meta. AMD, on the other hand, was climbing higher in the IV rank as the stock was breaking out. So it did the opposite. It flushed down big once the IV rank came down. You see, Tesla is the same thing. It was moving to 100 as the stock was going higher. But now that the IV rank is down from 100 to 71, it happened as the stock was going down. You can spot the opportunities based on the increase of the IV rank. And of course, the biggest opportunity right now is NVIDIA, because the IV rank is around 58, which is reasonable for NVIDIA. Will it go to 100? With certainty. That's not even a question. With certainty, we're going to 100 in IV rank in NVIDIA. Question is it going to be up or down? Are we going to see a big pop, a reversal in NVIDIA, increasing the IV rank to 100? I would say the odds right now say that the IV rank will increase to 100 in NVIDIA on the way down. But there is one level that has to be broken first. We'll talk about that in the charts analysis. Anyhow, we look at the unusual activities. During the session on Friday, here it is. We have VIX calls. Somebody sees VIX going higher. They bought the 21 calls, the expiration date, August 21st, spending over $13 million in those. This is a big one. It shows conviction, and I have no doubt that the VIX will be at 20, if not even above 20, way before the expiration date of August 21st. Then we have the EEM. This is the Emerging Market ETF. Highly unusual. Somebody bought the 45 calls, expiration date, September 20th, spending about $1.5 million. We know what the case against the EEM is. It's the Donald Trump election trade. Plus, of course, if the dollar goes higher, then the EEM is not going to do pretty good. But if you're betting for the EEM going higher, you're either betting that we'll see the odds of Trump going down, being president going down a little bit, maybe the Democrats will introduce something, or you'll see the dollar going down, rebounding, then heading down, or you'll see intervention by the Chinese government. We had a closed-door meeting with Xi Jinping this week. So are they going to ease? Is there stimulation coming? Who knows? But the trader here is betting on the EEM to go higher. What about MCK Mckesson? I believe Warren Buffett has it in his portfolio. It was a value stock for a long time. I owned it before, but here, the stock went way too high for a value stock. Now, somebody's betting that we might have peaked in the stock and heading down. They bought the 570 puts, expiration date August 16th, spending a little over $400,000. Now, since I couldn't get to update you on Friday as I was traveling on Delta Airlines with no services at all, we've done some trades in the morning brief against Ford on my Discord. We got the 14 puts, and Ford flushed down indeed on Friday's session. And the case was clear that we might have marked the top, so you got to take the shot here. This trade is closed right now because it printed about over 60% worth of gains. So you had to book that. Ford has an earnings report coming out next week. And maybe when the report comes out, it'll be an opportunity to buy as we see dividend-paying stocks moving higher. We'll see what happens. We also got a trade for CMG Chipotle with the 55 calls. That trade is down about 8% right now. The expiration date, of course, of next week, all of them. But I'm going to stick with it a little longer, and the reason is you look at the chart of CMG Chipotle. It is way oversold. At the lower Bollinger Bands, the IV rack went to 100 as the stock was going down. I think we have a rebound before the report comes out this week. And if we go to 55, 54 and a half, let's say, before the report comes out, I'll dump the trade, book the profit, and see what happens when the report comes out, because it could be bad news. With them reducing the portions and customers now moving away, it could be bad news. But the trade could be good between now and this report coming out. So I'm keeping it, and we'll update you, of course, step by step. Moving on to the charts analysis, we begin with the SPY, the S&P 500. What do we see here in the hourly chart? Can we make a case that the S&P is oversold on the hourly chart? Of course. Due for a rebound, gotcha. But that's not the only dynamic in play. We lost 550 on Friday's session. Depending on how we receive this Biden dropping out news and the increase of volatility or lack thereof, we could see another flush down. But there is no doubt in my mind that this week we will see at least a rebound in the index level and a pullback in the VIX. There is no doubt in my mind that we will see this. The problem is it lasting? And how long will it last? Because when we look at the daily charts for the E-mini futures for the S&P, I'm showing you different charts of the same name because I know traders trade different charts. So if we look at the E-mini futures, we still have the trend line that we need to go back to and retrace. And that could take us down below 5,500. Furthermore, if you looked at the wave study that we've done on the hourly chart of the SPY, the wave has to end. Go back to that conversation from last week. Look at the wave in the MACD on the daily chart for the E-mini futures. Is this finally the correction of the wave? It appears so. It appears that this is the time when we see the break of this wave. We got to go back to the mean, to the zero line. Usually we cut below in the MACD indicator, which means that we're not done with this correction yet. So whatever rebounds you get in the hourly, be careful. If the daily doesn't improve, if the rebounds are not strong enough on the hourly to change the daily, then these rebounds are not going to last. And my parameter here is any rebound we get in the hourly. If it doesn't get us above 5,621.25, when we close above, then I don't trust it. I think it's going to be faded away later. We see the correction resuming. What happens if you're trading the SPX, the cash index? Here's the weekly chart for you. The trend line here goes a little longer, and we're not there yet. We can go there if we go down below 5,400, maybe 5,300. And again, look at the wave in the MACD in the weekly chart. Is it coming to an end? And if it is, we go back to the mean, the zero line, at least. Then the correction will take us way below the trend line, that's for sure. It might take us all the way to the lows of the previous correction we got this year in the month of April. Looking at the Qs, the NASDAQ hourly chart, what do we see here? The question is Is it oversold? Without a doubt. Are we at least trying to find a bottom here and reverse a little bit? Yes, we are. The question becomes, are we going to do any significant recovery on the daily chart to say that we're reversing trends? That's only going to happen if we capture 487 on this hourly chart that you see right here. Because you look at the daily chart, we've lost the trend in the Qs. We have plenty of gaps below the fill. And if you look at the wave in the MACD, it is done. The bullish wave is done. We're going to do a correction now. And the correction could take us all the way down to the zero line, if not even below. If that is the case, we'll be at 460-ish by the time it finishes. So we might have more downside to come before we find a footing. So do not trust any rebound on the hourly unless it takes us above 487. And we close the day above 487. Because we can get a rebound, sure. But if we stall at 487, we could come down and form a topping inner shoulder, and that would be a trap. So be careful with any rebound that doesn't take us closing above 487. Here's the NASDAQ futures. We talked about the MACD wave. Third time is a charm. Indeed it is. And now we're doing a correction of this wave. It's not going to end until we get to the mean, and perhaps sometimes most of the time actually. It breaches the zero line going to negative before we see the birth of a new wave. For now, we got the trend line. That's going to be support number 1. If that's lost, I will look down to 19,000 as support in the NASDAQ futures. We'll look at the NDX weekly chart. What do we see here? Number 1, you have to look at the bullish wave that began all the way back in the year 22, the end of the year 22. And it just keeps going and going and going. We've had corrections in the wave, as you can see in the weekly MACD indicator. I'm highlighting them for you. But the wave never ended, never went back to the mean, to the zero line, or going back negative. It will, I promise you. But the question we have to answer right now, is this it? Is the third time a charm and the correction happens? And if that is the case, then we're not only going to go down to the lows of the year in April. If that is the case, we're going back to the lows of October of last year. So buckle up your seatbelt here. But we need a lot of confirmations on the hourly, on the daily levels before we talk about the weekly getting us down to the low from October of last year. One step at a time. Because if you look at the Fibonacci support, now that we have a clear bottom and a clear top, at least for now, in the NASDAQ and DX, we zoom back till the bottom of 22. If we have a correction right now as the first step in the weekly chart, finally, in the NDX, the first one, by the way, since again the bottom of 22, we will find support at about 18,271.89. So that's going to be number 1. If we take that out, then the October bottom from last year becomes the one we look forward to. Here's the IWM small caps. What do we see here on the daily chart? Last week, we had a topping candle. We thought it might be it, but then we got a few days of a pop, couple of days really. And then Wednesday, we got a nice print for a top. Way stronger than the previous Friday. Why? Because it came at a higher volume, number 1. Number 2, we actually got a red candle, not a green candle. So we lost during that day all of the gains. And after that, of course, you got to take a shot at a correction in the IWM, and we did. The question now, does the IWM continues in this correction of the move? Possible. And I got a target for you. We talked about it in the previous videos using Fibonacci's retracement. And it's going to be in or around 211. If we continue to go down, we should find support there. But do not dismiss the risk that we could see an ABC pattern in the making, and we actually blast higher, making higher highs in the pattern. But that's only going to happen if you go back to the intro of the video. We talked about what's going to bring the rotation to risk on again. The best case is a tame PCE. We'll look at the dollar index. We got a rebound, got a reversal for now. Can we argue that even if we pull back, we might find somewhat of an inverse head and shoulder pattern? That is the thinking for now. If the dollar is going higher, that's going to hammer a lot of assets, at least in the commodities side. You'll see damage in the stock side too. But of course, we look at the old man gold. You got a correction from the dollar going higher. The problem is it lost the triple top at 2,431.78. It's not a major problem yet to say that, hey, gold was a trap. I actually think otherwise. I think gold will provide us with an opportunity to buy. But that's only going to happen when the dollar finds the ceiling and begins to reverse down. Could happen this week based on the data. Now, I would look at gold as an opportunity to buy, but of course, there's a level where I don't want it to lose, which is 2,392. If you lose that, then the possibility and the odds for a trap increases dramatically. Now, silver, of course, the SLV is a different story. It has a confirmation of bearish reversal on the MACD indicator. I think we go down all the way to the lower Bollinger Bands, 26, if the dollar continues to move higher. We might even breach the lower Bollinger Bands. So I still favor gold over silver. I look at the SLV as tradable. I look at gold as investable. But we need the dollar to show us where it's going to stop. We know that the dollar is going higher right now. Where and what will stop it? Can the PMI stop it on Tuesday? Of course they can. Can the PCE stop it on Friday? Of course it can. If the dollar reverses after a rebound, then you got to buy calls on silver and GLD. for a rebound and then decide which one you want to own in your portfolio. When we look at light crude futures, oops, we lost an important support here, 81.37. We got a confirmation of bearish momentum in the MACD indicator. It is imperative now for crude oil to keep the level of 78 as support. If we lose 78, then we got a problem. We have probably a recession going on in the economy, and crude is sniffing it. Otherwise, if we have a rebound in crude Monday, then it was just an options phenomenon. In the meantime, when we look at the XLE energy stocks, outperformed the commodity this week. We got a bullish breakout, but we hit resistance we're supposed to, 93.81. What we want to see right now is a pullback all the way to the 20 days moving average, the point of a breakout in the resistance line in yellow, which now becomes a support line. If that is the case, then we have an ABC breakout. But we need to see crude oil finding a footing first. Otherwise, energy stocks, the outperformance versus commodities is not going to last. We look at the 10-year yield, also finding a footing along with the dollar. The question is, for how long and what will reverse it or accelerate it? We have a lot of macro data to come. But the point being, now that we've seen at least a short-term bottom in the 10-year yield, are we seeing a short-term top in the XHP home builders? Absolutely. Can we see a retracement? Let's say to 110, 108.44. That's very possible, and it opens the trade, at least for a retracement to these numbers. But I need to see a little more, because we talked about the risk of the IWM forming an ABC pattern. There's a risk that the XHP could be forming a bull flag here, just consolidating to pop higher again. So the macro data will be imperative in which way this trade is going to go. If the PMIs come out hot, if the PCE is not tame enough, then yields will continue to go higher and the XHP will go down, perhaps below 108.44, and vice versa. If, of course, the PMIs come out soft, if the PMI comes out tame, then we will see a move higher in the XHP as yields go down. The same goes for the IYR. I think for now, the most immediate move would be corrective, because we went way too high, too far in a short amount of time. Profit taking. But then after that, we depend on the macro data. The same goes for the KRE regional banks. Way too hot right now. The most immediate move should be to the downside, but we're going to be dependent on the macro. So if we see pullbacks, let's say Monday, Tuesday to 53 or 54, but then the macro comes out more favorable as we see the PMIs tame and we anticipate the PCE to be tame, that'll be a dip buying opportunity, but it will be a shorting opportunity if we see hotter PMIs right off the gate. The VIX daily chart, I'm not sure about this wick. I don't know where it came from. I think it is a mistake in the chart, but the point is, we've been rallying higher in the VIX in a breakout as we anticipated. I said we're going to be above 15, no doubt about it. We're closed at 16.51. Is it too hot in the short run? Yes, it is. Would I be surprised to see a pullback in the VIX to 14.87 as we see a rebound in the major indices because oversold, because Google comes out with some hope? That could be the case. But when we look at the weekly chart, every time the VIX broke above the 20 weeks moving average, we have seen a continuation of that move to expand the Bollinger Bands higher, as you can see in every single time. So while we might have pullbacks in the daily, the weekly suggests that these pullbacks in the VIX will be short-lived and higher we go again, which means that any rebounds in the major indices will be short-lived and down we go again. Here's the big Kahuna Apple hourly chart. What do we see here? We talked about the topping hinge shoulder pattern. We took a short on it. It gave us the bear flag for now. We're holding on to 223-ish as support. The chart is a little oversold in the hourly, but I think that it has more downside to give. If you look at the weekly chart, for example, rebound on the hourly or no rebound, we got a bearish engulfing candle. I think we have more correction to do in Apple in the next few days and next few weeks. If you look at Tesla, daily chart, the possibility of an inverse ABC is highly likely. The question is, will it happen before the report or not? Because once we get to the report, I believe it is Tuesday, we become dependable on the fundamentals of the company and the mechanics of the options market. I think we have an explosive move to come. I can make a case for 300. I can make a case for sub 200 for Tesla. So this is why I say if you want to trade this name, trade it all the way till the report. But you got to close it before it comes out because you're going to assume a lot of risk. If you want to bet to the downside and you're lucky enough to get the C break, let's say to 230, 220, at book profits and move on. You don't want to take the risk all the way till earnings because you have no idea which way it's going to go. The question now becomes, is it smart to do a straddle trade? You buy a call and a put. Maybe, but it's going to cost you a lot. You're going to need a move of about 20% to make your money back. And this is why I'd rather for the volatility to cool off after earnings and then follow the momentum that comes out of these earnings. If it is, hey, Tesla has a lot of problems, and the move before the report coming out all of this rally that we've seen, about 50%, is not warranted, and we go down in Tesla, then I think there's more where that came from. Look at how far and wide the Bollinger Bands are. Let's say Tesla, after the report, comes down to 220 or 200 because the report is bad. I think with that confirmation, I can buy some puts and follow that momentum all the way down to the lower Bollinger Bands, and vice versa. If Tesla goes down, let's say to 230, 220 before the report comes out, then it pops back to 230, 240, then I think it might finish the move all the way to the upper Bollinger Bands. In that case, we want to be in the call side. The bottom line is, big move coming in the souffle. We look at NVIDIA hourly chart. What do we see here? It continues to struggle, NVIDIA, at this point. We talked about the topping inner shoulder, the bear flag pattern, taking us all the way down to 117. Of course, we have this gap that we left open, and traders want to close that gap, and then we see what happens. That is a possibility, so long as we trade above 117. Boy, if we lose 117, it's going to be a major problem, because if you look at the daily chart, we do have support at the 50 days moving average in blue. That's about 116 right now. So we might find a rebound at the 50, but I think once we lose 117, it makes the 50 days moving average an easy target to breach below. And then you look at the weekly chart. What if we have an inverse ABC pattern happening in the weekly chart of NVIDIA that will lead us all the way down to the 20 weeks moving average? And then we find support. Then NVIDIA will be sub 100. So there's a lot of risk here against NVIDIA, the most important name for the indices. And this is why I'm not going to trust any rebound in the indices until we do major recoveries in those daily chart of the indices, and NVIDIA has to close the gap on the hourly chart and trade above the gap. Lastly, what do we see in tulips Bitcoin? Huge rally after the assassination attempt of Trump, assuming that he's going to be friendly to crypto. And we retested the breakout point at 63-ish, forming a bull flag, and we rallied higher. The good news for crypto investors, or Bitcoin investors for now, we've avoided a big problem here. On the weekly chart of Bitcoin closing above the 20 weeks moving average, that's a positive development, because everybody was concerned about that becoming resistance. And down we go after that. What is the next challenge for Bitcoin? We do have a sloping line of resistance showing lower highs. If we stall here, forming another lower high, then we got another problem in Bitcoin. And of course, they're talking about Donald Trump speaking in the conference and all of that. You got to be aware of the sell the news phenomenon. We could rally all the way till the conference and the Trump speech, and then they decide to book profits and dump it down. Because instead of talking about how he likes crypto, he segues and talks about random shit. So be careful here. This resistance line is the most important one we have to look for this week. Break above or stall and head down again. Let's move on to the conclusion of this video. What do we have on the economic calendar this week? Monday, we got nothing. 22nd, we got nothing. Could be a good day for the market to at least try to rebound. Then Tuesday, the 23rd, we get some macro data from existing home sales and the PMIs. Those are going to be important. Wednesday, the 24th, we have new home sales. And then Thursday, 25th, we have GDP, initial jobless claims, durable goods, the trade balance, retail inventories, wholesales inventories. And lastly, Friday the 26th, perhaps the most important day, we have the PCE report, really important to the Fed. And on top of that, we see consumer sentiment, the final reading coming from the University of Michigan. But of course, the earnings calendar is more important. And this week we have Google, Tesla, Visa, AbbVie, Coca-Cola, Thermo Fisher, McDonald's, Texas, Donner. On top of that, we have IBM, Philip Morris, Comcast, ServiceNow, NextEra, Union Pacific, Honeywell, AT&T, Raytheon, Lockheed, UPS, Chipotle, and a lot more. Things are about to get really, really interesting. Can earnings shift the tone and the narrative in the market, or will it advance the negative sentiment and narrative against the big caps? Most important earnings, without saying, is from Google, Alphabet, and that comes out on the 23rd. Folks, if you like the show, return the favor by pressing the like button, subscribing, and leaving us a nice comment. And consider, of course, joining us as a member here on YouTube or Patreon, links in the description, so you can access the daily videos and the coverage, in addition to access to my Discord and bonus videos. But with that, this is all I got for you for now. Thank you for listening, thank you for watching, and I will talk to you again tomorrow. Good night.
Cowards rule the world these days, Rep. With coward rules and coward customs. To succeed today, all you gotta know is how to blame and how to complain. I truly believe it's a survival of the unfittest these days.